Good
This
job.
conference will now be recorded.
Supposed to be reminding me. We'll let Crowder help you too. Okay. So we we're reviewing the financial and accounting theoretical framework because managerial accounting assumes you know how to do this. And then we layer managerial accounting on financial. So everything that we did in financial accounting, uh, we do that. Plus, uh, we add the managerial things on top of that. So just assume you know this, so we're going to review it. Yeah, you should be able to prepare an income statement, statement of retained earnings, a balance sheet, and a statement of cash flows, and that's what your problem is going to entail. So these four financial statements, this is what you're supposed to learn how to prepare in financial accounting. Can everybody prepare financial statements?
Yes. Yes.
Is that everybody? We have to, okay. Okay. Why do we prepare financial statements? Management needs them. Employee, if you're going to work for a company, you need to be able to review their financial statements to see whether you think they're viable or not. I mean, the healthcare facility just closed. Nobody knew it was closing. So if you looked at the news yesterday, well, they have accounting records, but evidently, employees didn't know anything about it. And so you can't just go work for a company in general, but especially in these times, they're shut the doors on you. So you want to review the financial statements if you can get them. Investors, creditors, tax authorities. So no matter what your major is, you need to understand financial statements. That's the bottom line of business. We have generally accepted accounting principles that are put out by the Securities and Exchange Commission, Financial Accounting Standards Boards. And we have these 15 principles that you can scan. We're not overly into that in this course. Let's see if we can get where we are. So this is you, an entrepreneur, making your product for this business. So that the project is your main takeaway from this course. In financial accounting, we always bought something, but now you're making something and you're going to create a business plan. So you should have all of this information with it and a few other things. You need a name for your business and everything else. You should stock. We did a little bit of this last time. But the key thing, you prepare these financial statements. And we said to prepare financial statements, the starting point of accounting is always what? The accounting equation. Assets equal liabilities plus stockholders' equity plus common stock plus retained earnings. Retained earnings consist of revenues, expenses, and dividends. So this is the fundamental equation for accounting. Assets equal liabilities plus common stock, and everything falls off of that. And we said if you started a business with cash of 100,000, you put that 100,000 in. The objective of the business is to increase cash by earnings, not by borrowing money, to increase the cash through earnings. We use double entry because in a transaction with someone in your business, When you receive something, it's a debit. When you give up something, it's a credit. In any transaction that happens, you get something, a debit. You give up something, that's the credit. Debit's on the left side, credit's on the right. So turning back to our equation, assets are the debits, liabilities are credits, common stocks credits, retained earnings credits. If the business is doing well, revenues are credits, expenses and dividends are debits. So typically in the business, we're getting assets, that's why they're debits, and we get them through either liabilities or paying cash or through earnings. So you always be kind of familiar with this. And the other thing that, let's just look at this. In double entry accounting, say you bought a car for $10,000. You received something of value, that's the auto, is debited. You gave up cash of 10, that's the credit. So what you receive is the debit of value. What you gave up is the credit. Here we bought the car for cash. You could have also bought the car with a note. Still got a car, but now what you gave up is the note. And finally, you could have paid something down and signed a note for the balance. So now you still got that same auto, but your cash is credited $2,000 and notes payable. Debits always must equal the credits. And so to get to financial statements, we said that there were 9 steps. You analyze transactions, you make the journal entries, you post to the ledger, you prepare the trial balance, you make those wonderful adjusting entries to get your adjusted trial balance. Then you prepare your financial statements. So that was kind of a 7-step process. Then we close the accounts out, the temporary accounts, and we prepare a post-closing trial balance to make sure we're in balance. So this is that a cycle that we worked on most of the semester. We're through midterm. And so we're reviewing the cycle, and then you have a problem where you will work on it. Another key thing is with assets, they can have debits increasing, credits decreasing, but their normal balance is supposed to be a debit. Contra assets, like accumulated depreciation, credits increase them, debits decrease, and their normal balance is a credit. Liabilities, credits increase, normal balance is a credit. Common stock, credit increase, debits decrease, normal balance. Retained earnings, credits increase, debits decrease. If the company's doing well, the retained earnings has a credit balance. If it's not doing well, it has a debit balance. Revenues, credits increase them. Expenses and dividends, debit increase them. So, you always want to sort of be familiar with this. Then we have these transaction types. When cash comes into business, there were 6 entries that were involved with cash coming into the business. When cash goes out of the business, there are about 11 items. 11A is treasury stock. Okay, so cash comes in, 1 through 6, cash goes out, 7 to 11A. So we're adding a couple more in here now. Then you have these asset transactions other than cash. So when cash is not involved, then you got to find your transactions over here. So what this chart did, of course, was to tell us, given that we had a transaction, what did we debit, and what did we credit. So it was a frame of reference for you to make journal entries so we could ensure that you could make them. Then we have the chart of accounts. You don't create any accounts. Here are the accounts here. And when you make a journal entry, you always choose your accounts and you put an account number down. So you didn't say asset purchase. You had to pick, was it supplies, was it land, and pick a particular asset. So let's look at an illustration of some journal entries quickly. If we invested $10,000 into the business, the journal entries, we debited cash and credited common stock. Any questions about that journal entry? Can everybody make that journal entry?
Yes. Yes.
Okay. Sometimes we buy our stock back, but we know that the common stock is the legal capital, and you would need some additional paid-in capital to do that. But let's assume that we bought 1,000 shares of common stock, $1,000 back. That is, you had a team and somebody didn't do what they're supposed to do. So you gave them their $1,000 back. You would debit treasury stock and credit cash. So you would not debit common stock. The common stock had to stay there. And then, so we're going to highlight that this is treasury stock. Treasury stock has a debit balance, okay? So this is a new transaction for your new account, treasury stock. That's when we buy back some of the stock that we issued, okay? But you want to show that because you're not supposed to be taking the stock out unless you got other capital. But you can't just take money out the business. Once it's in there, it's there. We had a cash sale of $50,000, debit cash credit sales $50,000, collection of cash on accounts and corporate customers $20,000. Type 3, we debit cash, credit account receivable. Then we borrowed $25,000 on a short-term note. We debited cash, credited short-term note payable. We bought supplies for cash, debited supplies, credit cash. And now we're into the paying journal entry. We paid on accounts payable. We debit accounts payable, credit cash. Then we pay rent, debit rent expense, credit cash. We pay dividends, debit dividends, credit cash. Are there any questions on any of these journal entries? Everybody can make these journal entries.
Yes. Yes.
Then we bought some supplies on account for $8,000. Credit accounts payable for $8,000. Okay. Then we had our sales on account. And you all did well on this typically. You would debit account receivable and credit sales when they're on account. That's your 15. And then when you collect the cash, 3, but you can't have a 3 unless you had a 15 prior. Okay. We said that we bought $1,000 worth of supplies for cash, and we bought $8,000 worth of supplies on account. We come to the end of the period. And we only have $3,000 in supplies. What is the adjusting entry to record the utilization of the supplies? So give me the adjusting entry to record the utilization of the supplies. Don't hear you all. I say I had this down. What is the adjusting entry to record the utilization of these supplies? Don't everybody speak at once. Do I have any A students?
Wait, what did you say? What's your question?
We have supplies of 1,000 that we bought. Then we have supplies of 8,000. I'm saying at the end of the year, you got $3,000 in supplies. What is the adjusting entry to record the utilization of the supplies?
Oh shoot, no, I don't know that.
You don't know that, Clifton?
It's I don't.
Wait, I think I know. Hold on.
But tell me, beautiful, what is it? If you had $1,000 in the bank, Clifton, and if you put 8,000 in the bank, and you had 3,000 at the end, how much money did you spend?
Six.
Wait, say it again.
You had $1,000 in the bank. You put an additional 8,000, but come the end of the month, you only got 3,000 in your account. How much you spent?
$6,000.
$1,000.
That's all.
You
Yes.
said it different.
Yeah, you did. You said
It was
You-
the verbiage that was a little
That's
confusing.
why I was like confused on what was you asking because it didn't sound like no. Yeah.
You said you called it the adjusted what?
I asked you for the adjusting entry if you would utilize those supplies.
Okay,
All right.
$6,000.
We bought the treasury stock, so everybody know that when you buy treasury stock, we debit treasury stock and credit cash. When we buy our stock back, we don't debit common stock. We clear on that one.
yes.
All right. All right. We buy an auto for 10,000. We pay cash down of 2 and note payable 8. Is that clear?
Yes.
So what I want you to do is to give me the entry to record depreciation expense at the end of the first year. If the auto has a 4-year life and we're using double declining balance. Is that clear to everybody?
If it has, repeat that again.
Okay, you know, auto goes down in bank.
Mhm.
What I want you to do, that
Is
talk,
the depreciation?
right, I want you to record the depreciation expense at the end of the first year if we're using double declining balance and the asset has a 4-year life and 3,000 salvage. Calculate the depreciation and give me the entry, the adjusting entry for depreciation. Now, does everybody understand that? Do you know how to calculate depreciation? Okay.
Can you remind us?
Yeah, that equation I remember from last semester, but I need a review.
Okay. You have to come up with a DDB rate. If it was straight line, it'd be 100 divided by 4. But because it's DDB, it's 200 divided by 4. So your depreciation rate is what? 50%.
50%.
So you're going to take 50% of the cost of the auto. So you would debit depreciation expense for 5,000 and credit accumulate depreciation for 5,000.
Okay.
Or the salary. So are we clear on that now? If it was straight line, how much would it be? If we ignore salary, it will be 2,500. So let's just forget about salvage. It'd be 25% of the 10,000, and it'll be 2,500. Okay. Any questions on that?
Not yet.
Say what?
No.
Suppose you sold this car for $3,000 in Buford at the end of the year. What you gonna do then?
If I sold it for $3,000.
Mm-hmm.
Okay, what are you asking me? If I sold it for $3,000 and what?
Make the
Like, what
journal,
would I have left?
make the journal entry to show you sold your car. You ever sold a car before? So your business sold a car for $3,000. So we know we're gonna do what? Debit cash for what?
$3,000.
All right, so we're going to debit cash. Insert some more rows below. Insert. Okay, so we know that we're gonna get 3,000 in cash, right?
Yes.
But how much did the auto cost us?
Are we still using 10,000? Or no?
Yeah, I gotta use 10,000. So we got 3,000 in cash. The auto cost us 10,000, but we're not balanced. That depreciation we took, we're gonna bring that account in here too. So we're gonna get accumulated depreciation. So we're gonna debit that account because that goes with that asset. So accumulate depreciation. We're gonna debit it for the 5,000 depreciation we took. We're still not in balance, Buford. So the only way we can balance is we gotta have another 2,000 over here. And so we'd have a loss on the sale of a non-current asset. So I think that's transaction 6, I believe, loss on the sale. So this is not inventory, long-term asset. So we'd have a loss on the sale of this asset of 2. So you still got the balance. So the bottom line is that whenever we sell a depreciable asset, we take off the cost and we take off the depreciation, and the difference is the gain or loss. If we sold it for $6,000, then instead of a loss, we would have had a gain on the sale of the long-term asset, and that will come over here. So the equation always has the balance. So this is a new journal entry. We talked about it a little bit, but we're just showing when you have a depreciable asset, you buy it, you take depreciation on it. But when you take this depreciation on it, if you sell it, you got to pick up that depreciation with the cost. So you don't just pick up the 10, you pick up the depreciation too. Any questions? So I think those are most of the journal entries that you have. Then what do we got to do next? Post to the ledger. So once you get your journal entries done, you post them to the ledger. Then you prepare a trial balance, which is what we're checking for, making sure that we're in balance. Then we prepare the income statement, revenues less expenses, net income, statement of retained earnings, beginning plus net income less dividends, ending retained earnings. And then the balance sheet. Now, continuing students, you will have a beginning and end of the year balance sheet. So you have beginning balances, and you're going to have two balance sheets, beginning of the year and end of the year. Any questions? So on financial statements, the balance sheet, we start off with where we were. The income statement tells us what income we made. The cash flow statement tells us what cash we made. The statement of retained earnings tells us how much of the income was retained in the business. And we get to the ending balance sheet. Then we have, what else do we have to deal with? We have those wonderful closing entries. You all remember closing entries? There are
Yes.
four. Oh, got it down. We close out all the temporary accounts. Every account below retained earnings is temporary. So all the revenue accounts are closed out. All expense accounts are closed out. Then we close out the net income and loss. Then we close out dividends. So when we make the closing entries, all the accounts below retained earnings are closed out. So we keep our accounts in order: assets, liabilities, common stock, retained earnings. So we close out the revenue first, then we close out cost of goods sold and rent, then we close out the net income, which was on the income statement, and finally we close out dividends. So those are the four closing in. But you see, I got those down. Everybody, so you all should better knock these problems out real easy. Are there any questions on anything I've covered?
I have a question, Professor Boyd.
Yes.
Well, I know that you record. I saw that you recorded once I got on. So will these videos be available to look back on?
Yes.
Okay, great.
They are available. I have a YouTube station.
Okay.